Hi, this is Junaid, back with another video. Today we're going to discuss evidence-based investing, a clinician's guide to financial literacy. This is a little out of the topic for me, but the important thing over here is to realize that the times have been changing. After post-pandemic, the macro trends in the market have significantly shifted. And I'm going to tell you through my own personal journey that how I have gone through financial literacy process, and you may or may not take the same advice or actually find your own path. This is not something to actually give you direct financial advice. I'm not a financial expert. What it is to actually just share my path to you so that you can do the similar thing in your own lives, because I think it's extremely important, as I'm going to explain throughout this particular video. Again, I also make these educational videos that have medical disclosure, so I think it's best to put it all out in the open so anyone can view exactly what I do with my investments as well. So this way, it would be both at a complete open disclosure, and then secondly an educational and fun, hopefully, lecture for you. I'm not selling anything in this product. There's nothing in this particular video that there is a sponsored place or anything like that. So this is not, again, not to either pounce about it, or it's just an idea that you should ponder to, and we'll come to these points in a minute. So let's start with why. What happened really that actually made this whole financial journey for me of personal freedom, financial freedom, became important? I mean, clearly we have all gone through a significant amount of training. It's 15 years of training. And then after that, I started working like a dog. And that was like 3.5 years of neurocritical care and stroke, about 46 weeks out of the year. And that was something that, I also wanted to do some telemedicine. As a matter of fact, I was hired by VMed because of that. The question really was that at that point in time, I really wanted to make sure that I also follow my passions as well, which always cannot happen during the training process. So during the training process, those were all on hold, and then I actually literally worked like a dog. And then that came out through some fault of my own. And then of course there's other factors that are involved that, I realized that most important thing is in my life is actually time. So therefore I reprioritized. I had a paradigm shift in what I really wanted to achieve, and then I changed my sort of a strategy to have some financial freedom, and then not just focus on wealth itself. And that was my personal sort of paradigm shift, and I wanted to share with you guys. And this is not new. I mean, this has already been published. If you look at some of these articles from White Coast Investor, how I turned my plank into a runway. And this also discusses financial freedom. Another article at Kevin MD, you can see that how the financial independence evolution shaped for this particular person, the end of medical career. I do still 100% medicine. 70% of it is telemedicine, and about 30% of it is tele. But at the end of the day, if you choose so, you can potentially go that path as well. Not that I'm recommending it. Neither am I following it for myself. But again, this is not something that is happening all over the medical field, because there is an epidemic during the pandemic of burnout. So the key problem at the end of the day is the most important asset, the most valuable asset of yours is time. And the most important investment that you can make is in yourself. And by that, I mean that you can have more financial literacy. Because if you're going to do that investment in yourself, then you can reap those benefits for years to come. So it's important that you do that investment in yourself and learn some financial literacy. Bunny, this is a great quote that I really loved by Tim Denning. It's actually in the link below. Money buys you freedom. Freedom is gaining your time back. And when you have time back, you become a secret billionaire without the Lamborghini, which is great, because at the end of the day, there's enough after $210,000 per year. Your really lifestyle doesn't really change that much. There are actually studies being done that your lifestyle modification doesn't really happen that much, that with more money you don't really get a little bit more I suppose happiness. You do get more influence, I suppose, but at the end of the day, you don't really buy any more influence. Around 210K is where the sweet spot is for most people to have happiness. And that's where, that's also the realization that you have to live a little bit within those means, and this will bring you more happiness with less money. So the overview I want to go through this particular talk is we're going to discuss goals and strategies, then macro trends. We're going to look at my personal investment strategy about stocks, real estate, and then moonshots, for example, cryptocurrency. And we're going to talk about some of the other sort of investments, and then essential resources that I'm going to tell you what you should have some for pre-reading, and then continue to have your financial education so sharpen the saw, so to speak. So goals and strategies. So the clear goal over here is that there should be security and freedom. And then these are longer lasting goals. This buys you time back, decreases the stress levels, and you have time for your family. But if your goal is wealth, you can always continue to sell your time for money. And that is always short-lived. There is health consequences for it. There is relationship consequences to it. And there is actually definitely increased stress that comes with that particular goal. Again, you should choose whatever you prefer, but I actually changed my goal in life to have more time for myself. And the strategy that I adopted is of investment. It is not of trading. There's a huge difference. Investment has an outlook of years. It doesn't have an outlook for weeks. It is more so about retiring in a reasonable manner. I mean, not in a mansions or anything. And it has to do not with retreat, like you're going to work like a dog for 10 years and then just have a retreat. It's not that strategy. It is to actually continue your valuable time into the community as a physician so that you don't burn out and quit. So that's another thing. So it is about value, which includes both cost over time and then time consumed over just having this as goal is pure wealth. Again, that can potentially cause you to have personal financial freedom, but again, that personal financial freedom at what cost is going to come. So that's the key things that you have to understand as far as strategy is concerned. The macro trends are really interesting, especially post-pandemic. What really happened is that we have printed about 25% of the money circulation within the last year. 23.6% of all US dollar were created in the last year. And this particular graph that is from the Fed, I think it's from the St. Louis Fed, you actually see that at the end of the day, you're actually literally 1/4 of all money. That's a ridiculous amount of money printed just within the last year. As a matter of fact, this graph was before this $1.9 trillion stimulus, and then after that, there's a total of $5 trillion that have been pumped into the economy. That's a huge sum of amount. And if you get into context, the Obama stimulus relief package back when there was within the financial crisis was $840 billion. So there is no comparison about how much money has been printed and distributed within this pandemic. And that's not just here, it's all around the world. So the EU has printed it, China has printed it, etc. So there's a lot of money printing. The better technical term is quantitative easing has been done during this particular pandemic. What the effect of that quantitative easing is, basically it's a hidden tax. It's something like you're creating money out of thin air that doesn't go away. It has its consequences. And the reason that's been done is that it's just easier than taxing people, because there's clearly we have to take care of these expenses that came through at a government level. And rather than taxing people, which is extremely unpopular, what you end up doing is basically create quantitative easing. And then that quantitative easing, you end up basically building into the system a hidden tax. Now, what do you mean by that? So, for example, if I buy a house for $100,000 before the pandemic, and you have printed 25% more money, that by definition, the value of that house is $125K. That $25K may not appear right away. It's going to take 5 to 10 years or even 7 years to come in, whatever the time frame may be. But at the end of the day, you are paying 25% more for the same value of the house just because there's more money printing being going on. So this is the reason that we have to actually look into this as a tax rather than anything else, in my opinion. And then, of course, there's just hidden tax and there's clearly visible tax, right? I mean, there's a lot of taxes that we have to pay. So one of the things that you always have to consider is the most expensive line item in your book is what? It's actually tax. And you always have to have a tax harvesting strategy. One of the key reasons that I moved from Milwaukee to Dallas, Texas, is just coming to Texas was because it has no state tax. When I'm doing most of my work via telemedicine, it is through an independent contractor under my own company. What benefited me was actually save a lot of taxes through the S corporation, and of course there's no personal income tax in the state of Texas. Combining both significantly improved my overall tax burden, and in that regard alone, about 10% of the income can be decreased, or about I have to work less, about 10% for the same amount of money, which is huge. So that line item is extremely important when you're discussing, when you're thinking about a whole global strategy of your portfolio, where you're going to go, etc. And clearly Elon Musk said the same thing, and then he has moved to Texas because of that. So what is all this coming down to? All assets are going to go up, including, except for cash. So it is really the time to save, invest, change priorities, and invest, save, because we're going to see that these macro trends are going to catch up. And then if you haven't invested right now, all the assets are going to go up, and then some of these assets are going to be out of the reach. So it's important that you plan, because if you fail to plan, you're basically planning to fail. And that's what this whole discussion is all about. So what approach should we take? So there are multiple approaches that you can take. And as a physician, we do evidence-based medicine. So it's clear to me that the best approach would be an evidence-based approach. There's a hierarchy of systems. And then during that hierarchy, you go up and actually make a whole global strategy for your portfolio. But take this as important, because this is just one opinion. This is not a fact. What you have to find is that you have to look at my personal strategy and find your own facts. Just look at my opinion, but make sure that that particular thing applies to you in person as well. One of the things that I didn't realize when I was looking through this, that they're actually research papers exactly like we read in clinical trials in the medical field. These are same exact papers. People have gone through back data, do like retrospective chart study, they do the retrospective market study, and then they actually extrapolate the data forward and then give you their own conclusion. This is a prime example. If you follow that YouTube link, Ben Felix actually explains this particular paper, and then you can download and read it. It's open source, and the link is also in the description. It talks about basically the main important question, that time in the market versus timing the market. It says that the timing in the market actually does have a modest, if any, effect. Clearly, there must be, and I'm not an expert and I will never be able to time the market correctly. So what did I do this? Exactly like a clinical research paper, you have to apply it in your clinical situation. In the same way, what I applied it is in two things. Number one, if there is something that I'm to contribute, period, and then forget about it, like Roth IRAs and 401ks, I do it 1st of January, because I'm not going to take that money out, hopefully, and then I'm going to just leave it, and then I don't need to time the market for that. It just, the number of days in the market is more important than anything else. So clearly, I actually take that into account and just put the money that I have. But sometimes, like, there are volatile assets like Tesla stocks or Bitcoins. For those in particular, what I need to do is basically do dollar cost averaging. So this way, when I'm buying that stuff, I actually do dollar cost averaging and then make a strategy according to that. Again, clinical study, or basically evidence-based evidence-based investing research, rather than clinical application. You can have it a financial applications for yourself. So that's sort of been my goal, to actually approach this whole investing paradigm through an evidence-based, data-based approach. My personal investment strategy is basically very simple. I wanted to have a risk stratification. And the risk stratification that I did was that about 45% is real estate. This does not have about less than 4% return. It's safe. It actually has potentially a less downside. But again, this is not the end all or the be all. You can actually get better returns in the stock and with the same beta. What basically means is the risk ratio. But then about 45% of them I put in the stocks. My stock portfolio, again, is a little bit more riskier than the index stocks that are potentially there, which I do prefer index stocks, by the way. And then we come to moonshots, which are basically the most riskier, and therefore the green, yellow, and the red as far as investment is concerned. So let me go back and actually show you exactly what my stocks actually strategy is. So what I do is that I have this one Google sheet. And in this Google Sheet, the first thing is that this is basically my whole overview. This is the index returns, S&P 500, the healthcare, and then it breaks down into different sectors of the economy, and then it gives me the 1 month return, the year-to-date return, 1 year return, etc., and it keeps going. This is actually the data sheet that it pulls through, so don't change that when you're copying my spreadsheet, which you can get when you're subscribed to my newsletter. And then this I actually have it as a dashboard to monitor things. It's just easier for me to look at it like this rather than on different kinds of apps, but Finvix is there and there are multiple other places. Feel free to use your own monitoring tool, but this is my own personal built in my own hand, so I actually know where exactly everything is. Then I actually translate it into my own personal sort of strategy. So I have like a bunch of index funds, and then there's sectors that I actually have the kind of investment tickers that I'm using, the expense ratio of it, what is the 1 year, the 5 year chart, the 1 month chart, the 1 year chart, etc. And this gives me an overall and information about my own personal stock. So this is something that I converted back and gives me, and this is also the pulls the data. So if you're copying it, and you can change it over here to something else if you want to do it, for example Tesla over here, you can change that and it's going to load all the appropriate and then it's going to change it over here. Again, of course, there's Tesla twice, and now you can actually see that. So this is an sort of auto updates some of these things for you so that you can actually have the strategy. And then you can see that there's a collective return on these things. So the last sheet actually gives you the collective return, and then you can weight it, like how much you want to do it in a particular sort of subcategory. So the major categories are index funds, individual stocks, gold, which is commodities, gold and palladium, and then sectors including financials, healthcare, industrial, information technology, semiconductors, and solar. These are at least mine. So I actually designed that if I have to do what kind of subcategories that I'm going to weight it in. So that would be 100% of the sectors. And then I actually do this other weighing over here where the individual stocks are weighted and the gold stocks are weighted and the sector stocks are weighted. So this way I can change the weight in a particular way if this changes are happening or I'm sort of expecting. I don't normally change a lot of stocks all the time. Again, there are tax implications for it, so be careful. But what I do is basically that, let's say if I have thought that the market is actually going to go downwards or there's no real upside left with the individual stocks or the sectors, I put more money into the index fund. So I can change that into 50% over here, while I can change that into 10% and then 30%. So this way I can actually see what my 1 month return, when my 1 year return or 3 year return would sort of look like. So this way I can actually have a backward view myself of when I'm doing my own strategies. The tool that I use for investment is actually M1. This is again not a sponsored video or anything. If you go to the provided link in the newsletter, you're going to see that this whole thing is shared. So I can actually go back and change again, write exactly what I've decided over here as far as the sectors which I'm going to put the money in, and then this actually goes into sectors, individual stocks, index, and gold. And I can change this around as far as the whole sectors are concerned. And if I go into sectors, then it has tech, semiconductor, solar that I explained back, and they can go into each of these particular, and then change your target percentage for that particular subcategory of those things. And then you can go back and say individual stocks, index stocks, and you can actually say that, what kind of index stocks I'm going to put my money into. So those are the things that I've looked into it, etc. And there are multiple things that go into it, including diversification, risk stratification, etc. Again, I did my own research and I came up with this. I'm providing you the tools to do the research from the Google Sheet perspective, and then this tool is easy to just translate that into a doable strategy. So that is my personal stock strategy. There's a dashboard for it, there's monitoring, but you can use other tools, of course. There's Seeking Alpha Premium that actually extracts all the information from major investment, for example, M1 Finance, Fidelity, etc., puts it into one. It doesn't give you the subcategory of what the top 10 stocks of one ETF is, and I use ETFs a lot. So, but sometimes you can actually get into that information as well. So Seeking Alpha is one tool. Mint.com is another tool for net worth, and then Personal Capital is another one. Decide whatever you like, but at the end of the day, keep an eye on things. Do not just solely rely on someone else, in my opinion, because at the end of the day, it is your money and you should put it to work yourself, or at least have an eye on it, that how it is working for you. So that's sort of my conclusion on the stocks portion of things. And always keep an eye on the big picture, because that's the key thing. If you're not doing the big picture, then you don't really understand where it is, and then you should play with the weights and everything so that you understand, again, both the risk stratification and sort of the goal that you have in mind. So now come to the real estate strategy. As I said, 45% of my investment is under real estate, but again, the goals could be very different. My goal is not cash flow in the terms of actually having my kitchen supported by it, or it's not eating money for me. It is something that I just want to keep putting it in and then growing. So my whole idea is not to create a profit. As a matter of fact, a little bit of loss is kind of better, because again, it would be important to have some tax harvesting to be done in that regard. So if you have a number of properties, you can just say what is the final price of the property, what is the rent expected of it, what is the down payment, the loan, the rate amount, etc., management company fees, tax rate of property taxes, and that this all calculates to a profit and loss ratio. This is, again, $81. Clearly there will be repairs, there will be other incidentals you have to pay for, placement of the renters again. So you're probably going to end up in negative. But again, that's not the whole idea. The idea is that you actually create this, and I'm going to come to that in a minute. Let's say if this property is this, and I'm living in Dallas, Texas. The appreciation for Dallas, Texas is ridiculous. So if you look at the home appreciation price index monthly supply over here, this is home price appreciation at the national level. So if you go at the national level, you can see that the home price index is going significantly up, and this is recently up. Look at this, from 2019 all the way to 2020 over here, and there's a significant increase in the home price index. This is one of the ways that they measure how the home prices are doing nationally. If you look at the national level, the home prices are actually gone crazy. There's home price appreciation generally runs between 4% to 8%, and then if you look at it, the home appreciation within the last year has gone significantly up from 10 to 16%. That's just unheard of. And this is actually very important to understand, that how, as I said, because of the quantitative easing, whatever asset it is, it doesn't matter. I'm no genius. Or nobody else is, to be honest with you. You just throw a dart and you're going to make a profit in this sort of market. And the reason behind it is this quantitative easing rather than anything else. So these are the kind of things that you're looking at. And if what I do is I actually go into a particular area, and then rather than doing the metro, I can look at Dallas, for example, where I actually live now. So you can actually go back and look at what the markets are doing particularly in the Dallas area. And then if you go here in the home appreciation, you can actually check across metro comparison. So for example, let's just go here. You can see that this is metro distribution price tier low. So low end houses from 100K to 200K. You can see that the Dallas is actually doing around 11.5%, 11% or so. But again, that's a huge county. And then you have to look at the particular zip codes. There are, again, areas where you can have that research done. So you can find out exactly where your appreciation is going in this particular, and I'm just taking 7.5%. In Dallas. Again, if you're in Phoenix, Arizona, it's going to be 12%. If you're going to be, in Milwaukee, it's 8%. So you have to look at where the data is, etc. in that situation. So if you look at the 7-year appreciation, then this would be the final value of the house on year 7. This calculates the total of X amount of properties, what is the amount of loan, and then loan to value ratio, and then asset calculation in that, and then also the rent appreciation, and it calculates the whole thing. And this sort of helps me understand in terms of numbers what I'm looking at. Rough numbers, very rough numbers. Don't get me wrong over here. As I said, you have to factor in a lot of things in this situation. But this is sort of the sheet number 2 over here is you can design your loan amount, your annual rate, how many year periods, etc. And this sheet also pulls back exactly on year one how much loan is going to be, and then calculates the loan to value ratio for me, because the minute I go below 60%, I will refinance the whole loan and then buy another property once that happens. So the cycle actually continues in that manner. So the idea is the number of properties goes up, overall your profit goes up. So if you had 4 properties, you're with an initial investment of, let's say, 260K, you're actually looking at 7-year profit margin in this situation about this. So this is actually, yeah, no, this is asset calculation, yeah, about huge profits. So what I'm saying over here is that at the end of the day, you have to decide your own strategy. You should partner with someone or not, etc., etc. But what I'm trying to say is that have a strategy. It's extremely important. As you can see, that the data clearly suggests that the assets are going to go up and continue to keep going up. One of the things to remember is that you also have to understand that, is this something right for you? As I said, if you just do pure index fund, that's 11% return for around 50 years. That's great. I mean, for me, it was important because real estate is technically a lower rate of return, but that was my safe bucket. And then there's medium risk bucket and there's a high risk bucket. So you can design exactly the whole portfolio according to the risk stratification that you want to do in your own particular way. And there's no such thing as passive income. Like, clearly you have to work in it. And if you're thinking, oh, it's going to be automated and there's a managed company, it doesn't work like that. Renters have issues, you have to evict them, you have to get cleaning done. Even if you have a management company, it's a lot of work. So don't think of this as real estate as, you make money while you're sleeping. It requires a lot of work. But once it's set up and you go above 2 to 3 houses, then it becomes really reasonable, because the management fees combined makes a real good difference. At that point in time, you can be a little bit hands off. For 1 to 2 properties, it becomes hard, and to set up whole thing is actually, it's time consuming. But again, if you put that literacy in, if you put that energy in at the beginning, then it makes a lot more sense. Then the last 10% are moonshots. And that's according to your individual appetite for risk. Mine is 10%. And for example, my brother is 26-year-old, he's not married. I tell him that his moonshots should be about 30%. And there's a 60-year-old guy who's actually near retirement. I think the moonshot would be 2%. It depends on what your responsibilities are, how near you are at the age of retirement. And then you should ask yourself what should be the percentage for you to actually have these sort of moonshots are concerned. Because the whole mindset over here is you can lose it all. You can clearly lose it all. And even if you lose it all, it will hurt, but at the end of the day, it wouldn't be, catastrophic. So that's very important. I put private investment basically in a company or a corporation that, medical device company, etc., etc. And then about 5% is in Bitcoin. Again, I don't recommend that to any and all of you, but at the end of the day, that's what I'm doing, full disclosure. And if you really want to learn more about Bitcoin investing, there's a good YouTube lecture on the link by Ali Abdal that you can actually go back and look at it. Now let's come to reading. Before you do that, the financial literacy thing, these 3 books I think is extremely important to read, and read again and again, because literally the little book of Common Sense Investing by John C. Bogle, I have read maybe 3 or 4 times. Same thing, actually, the Boglehead's Guide to Investing is even better read as compared to the first one. It talks more about index funds, it talks more about patience, it talks more about strategy, and also talks about expense ratios rather than anything. Nobody does better, nobody really times the market better, etc., etc. So extremely important. And I will teach you to be rich is basically a mindset game. And again, the idea is that sometimes you have to spend a little bit of money to actually make more money, get the best financial advice, also enjoy the money you have. I enjoy my Tesla. Again, it sometimes feel like I should have bought Tesla stocks as compared to Tesla car, but hey, it is something that I enjoy. And the idea is that you need to figure out your paradigm within which that you're going to be actually doing this. So again, continue working on your continued financial education as you're working on your continued medical education. So this is a quote by Warren Buffett: read 500 pages like this every day. This is how knowledge works. It compounds interest. It works like a compound interest. And all of you can do it, but I guarantee not many of you will do it. So the idea is read, and I make a habit of actually making sure that I save articles in the pocket. I can discuss this at a later date, that how I actually make sure that I tag my read, highlight my reads, and organize my whole sort of knowledge-based system. And again, sharpen the saw from Stephen R. Covey. These are some resources that is going to be in the description as well that I think are important for you to actually follow. YouTube, Ben Felix, Common Sense Investing is a must watch. Again, he discusses more papers like situation where you can actually look at those papers and then decide accordingly. Gels Wealth Managers gives the best closing beat. I mean, better than even CNBC and all those people. And then reading wise, White Coat Investor is a must. Seeking Alpha, Motley Fool, Data-Driven. There are tons of stuff. Find yours. But again, have varied source of reading so that you're not stuck to one opinion, because that's very important. It's your money and you should take care of it. And the last and the most important thing is you should have a strategy, and most importantly, it's to stick to it. Financial literacy is the key for financial security. It is not just having wealth, because you can lose it. You can have health issues, you can have other kinds of issues. What are you overall planning as far as insurances are concerned as well, life insurance, etc. So you should also have a complete literacy of the whole system. Continue to read on it, plan and be patient. This is not something you make changes on a regular basis. It's important that you have some sort of a strategy and you're not reacting to the whims of the market or anything. You have a strategy and you're sticking to it, and then you're just doing what you are supposed to do, and not taking either unnecessary risk or not taking enough risk, because that's another problem, because you have to basically have a strategy of risk assessment as well. Monitor weekly, or monthly, whatever it comes down to. Continue reading, sharpen the saw. At this point in time, at least save and invest, diversify. And again, remember, tax is the most expensive line item. Please don't forget to subscribe to my newsletter and my YouTube channel. It really helps. Thank you so much. As usual, this is for physicians by a physician. If anyone saved a life, it would be as if it saved the life of all mankind. This is the motto of AI Neurocare. So visit my website, my YouTube channel, newsletter, and of course, follow me on LinkedIn. I'm very grateful for your time.